Good morning and welcome to the China General Chamber of Commerce 2021 U.S. China Cross-Border Investment and Trade Forum series. Today is our third and final session. We are going to discuss global trade and the logistics challenges in changing times. I'm Sherry Q, the Chief Operating Officer of CGCC. If you are not familiar with CGCC, we are an independent, non-partisan, non-governmental chamber of commerce with a mission to create value, generate economic growth, and enhance cooperation between the U.S. and China business communities. We provide a broad range of programs, services, and resources to cover 1,000 multinational corporate members. On behalf of CGCC, I would like to express my warmest welcome and appreciation to everyone attending our today's webinar. We are having a wonderful lineup of speakers today. Before we start, a few housekeeping rules. First, today's event will be recorded. While today's comments are on the record, the views and opinions expressed by our guests are there alone and do not necessarily represent the official views or position of the institutes they work for. If you have any questions during the course of the webinar, you are more than welcome to bring them up using the Q&A box located on the bottom of your screen. Our speakers will try their best to address during the Q&A session. Now, without further ado, let's welcome Chairman of CGCC, President and CEO of the Bank of China USA, Mr. Chen, to deliver the opening remarks. Chairman Xu, please.
Thank you, Sherry. Ladies and gentlemen, good morning for New York. Good evening for Beijing's guests. Thank you all for attending today's event, which will discuss the outlook of U.S.-China cross-border investment and trade. Since the pandemic, the United States, China, and the global economy have suffered unprecedented setbacks and face continued challenges. Although the current economic situation seems on some account to be improving, there is clearly still a long road ahead to full economic and social recovery. Climate change, public health, food security, economic equality, inflation, a global supply chain crisis, and the cyber attacks represent some of the many issues and uncertainty the world continues to deal with today. According to the latest data from the U.S. Department of Labor, inflation in the United States has accelerated in September. The year-on-year unadjusted CPI rose by 5.4%, reaching its highest level in more than a decade. If this trend continues, it will further increase the operating costs of a business and the living quality of households. It has already significantly impacted the small and medium-sized enterprises and has the potential to do much more damage. This also reduces American companies' competitiveness and attractiveness of FDI, thus further risking the prospect of economic recovery and social stability. While these various challenges are complex and in some cases driven by misinformation in the marketplace, I continue to believe that a more constructive U.S.-China collaboration model can lead us to a brighter future. Despite our many differences, one cannot deny the enormous benefit that the U.S.-China economic trade and investment cooperation have brought to both our peoples and the nations. This benefit includes the massive expansion of U.S. export to China, American job creation and support in the millions, and the importation of goods to the United States that eases the living pressures of millions and millions of Americans. Let alone, China's market is the largest consumer of American technology innovation, agricultural, aviation, healthcare, and even educational products. And the energy sector is also full of prospects. We have all seen the recent media reports on the disarray in the global supply chain. Well, the US economy struggles to recover and the consumer spending has increased in certain areas. A shortage in semiconductor chips, an ongoing rise in raw material costs, soaring shipping rates and delays, and the ongoing trade war with China will no doubt continue to impact the prices, profits, efficiency, and consumption across the board. In addition, when we see the enormous spike in global energy price, the prospect for quicker global recovery become even dimmer. This energy crisis further demonstrates the importance of strengthening the development of green energy supplies that promote environmental protection and reduce economic dependency on fossil fuels. The vast majority of experts and economists would agree that energy solutions and combating climate change are areas of common ground that the new U.S.-China relations can be built upon. It is of the utmost importance for all countries, led by U.S. and China initiative, to create a collective agenda and establish new agreement on environmental protection and new green economy that will benefit all citizens of the globe. Corporations, financial institutions, and chambers of commerce have already begun leading the way by developing, supporting, and enhancing programs based on new ESG standards and promoting the financing of green bonds and green energy projects both at home and abroad. We were all delighted to hear about the recent video call between the Vice Premier of China, Liu He, and the U.S. Secretary of the Treasury, Janet Yellen, on October 26th. The statements issued by both sides pointed out that the global economic recovery is critical and that both countries need to strengthen macro policy communication and coordination. Economic cooperation is not a zero-sum game by any means. Well, there are more hot topics and concerns over increased competition and the national security that benefit from our two nations' collaboration over the past 4 decades to our corporations, consumers, and communities outweigh any of these risks. As the world's two largest economies, we must have the vision, determination, and creativity to seize the benefits to the market and all of humanity, because we are able to well manage the risks. With a mission to create value, generate economic growth, and enhance collaboration between our business communities, CGCC will continue to serve as a contributor and a beneficiary of the strategic relationship between our great nations. This is why we're here today, and I look forward to an insightful and productive discussion about the opportunities and the solutions to these and other major challenges we are facing today. Thank you.
Thank you so much, Chairman, for the insightful overview. Today, we are delighted to have Lu Cao, Managing Director of Global Corporate Banking at JP Morgan, moderate the panel for us. Welcome to join us again, Lu. The program is all yours now.
Great. Thank you, Sherry, and thank you, Chairman Xu. And good morning, everyone. I'm a member of the Corporate and Investment Bank at JP Morgan, leading the North America relationship coverage of our Greater China clients. And it is my pleasure to moderate today's discussion with our esteemed panelists, each of them coming from key industry players. Mr. Liu Mengze, General Manager of COFCO USA, Paul Nazzaro, Executive Vice President of COSCO Shipping North America, Matthew Davis, Senior Vice President from Starr Marine, and last but not least, David Burge, Senior Vice President at Moody's. So before we kick off, let me first pass the mic to our panelists to briefly introduce their roles and their respective company's business. Mr. Liu, please go ahead first.
Hello, good morning, everyone. Okay, my name is Mengze Liu, but it sounds weird to most Americans, I guess, to hear this name. I actually worked in the US a couple of years, but now I'm in Beijing. When I was in the US, people call me Paul. But so it's like our products. When we import products into China, we always give them a Chinese name. So now, when I work in the US, I give myself an English name. So they call me Paul. You can call me either Paul or Mengze if you like. Okay, I work for COFCO Food Import Company. It's a subsidiary company of COFCO. COFCO is actually the leader of the agriculture and food industry in China, and one of the world's leading agri-product traders with global footprints and fully integrated value chain. The company I'm working for, COFCO Food Import Company, a subsidiary of COFCO, specializing in food import. The company was established in 2016 with a main office in Beijing and branches in Germany, the UK, and Japan. We import products like dairy products, wine, liquor, meat, aquatic products, fruits and juice, and etc. So we will also do private label as well. So we have a very experienced marketing team in China and strong nationwide distribution system in China. Thank you.
Great, thank you, Mr. Liu. Just to differentiate, because we have two Pauls, so which is why we're differentiating that a little bit. But we're going to go to the next Paul. For the intro. Please go ahead.
Hello, good morning, everyone, and thank you for having me here today. COSCO Shipping North America is a wholly owned subsidiary of the COSCO Shipping Corporation Limited. We are the regional management center for COSCO's business units in North America, Central America, and the Caribbean. We're headquartered in New Jersey, and we have two other business unit bases in the United States. One is in Long Beach, California. One is in Houston, Texas. We also have operations in Canada, Panama, and Mexico. This structure oversees and governs 33 regional subsidiaries and joint venture companies, collectively employing approximately 700 people in the region. COSCO's span is diversified over the logistics network. In our region, our concentrations are on container shipping, terminal operations, bulk and tanker shipping, logistics services, freight forwarding, vessel supply and technical support, as well as logistics equipment leasing and financing. Our major sectors in North America include marine terminal operations, where we are partners in 3 joint venture companies on the U.S. West Coast. We also participate in the equipment leasing and financial sector with a sizable fleet of approximately 36,000 units leased out to various supply chain providers throughout the United States. And we operate an extensive end-to-end logistics company, including trucking, consolidation, warehousing, and third-party logistics services. Thank you. It's a pleasure to be here.
Thank you, Paul. David, would you like to go next?
Sure, and thank you. Or I'm sorry, are you with Matt next or myself? Okay. Thank you. My name is David Burge. I am a Senior Vice President at Moody's Investor Service, and Moody's Investor Service is a segment of Moody's Corporation. Moody's Investor Service provides ratings and risk assessments to a number of entities worldwide across both private and public, across a broad range of industries, institutions, sovereigns, etc. I work in the corporate finance group, where I cover a portfolio of mostly large, mostly investment grade, highly multinational diversified manufacturing companies, along with several of my colleagues worldwide. I also head up a number of research initiatives in this sector, the manufacturing sector worldwide as well. I've been with Moody's for about 20 years now. I've previously covered a number of other industries, including transportation, business consumer services, certain technologies, etc. And I have a prior background in the shipping industry before coming to Moody's.
Yeah, thank you, David. Matt, please.
Thanks, April. Before I introduce myself, I want to say thank you to the Chamber for organizing this event, and I'm excited to be on the panel with my fellow participants. My name is Matthew Davis. I'm the Global Head of Starr Marine Companies. We are a global insurance company with a long history in China. We were founded in Shanghai in 1919 by C.V. Starr, and our current CEO, Maurice Greenberg, has dedicated his entire career to building strong and long-term relationships throughout Asia, and especially China, As a marine practice, we've been in underwriting risks for over 76 years, and we have dedicated offices in China and throughout the globe. We are the leading cargo underwriter in the United States.
Great. Well, thank you, panelists, for the brief intro. Now, let's get right into business on the first of our two main topics for today, global trade. Let me start with you, Mr. Liu, and let's talk a little bit about the Made for China concept that your company, COFCO, has created and how this is relevant to the overall U.S.-China trade activities.
I guess most people have heard a lot about Made in China, not so much about Made for China. We started this concept beginning of this year, which we received very good feedback from the market, both from the end users, the consumers, and our business partners. We picked this slogan or this concept firstly because it's very natural for us. We are a Chinese company, and our market is primarily China, and so we naturally the company made for China, and our products eventually are consumed by Chinese consumers. Secondly, you may ask why it has been made in China all the time, and now it's made for China. So actually, it's actually reflecting the change in the trend, in the flow of goods in the market. We noticed that in the past few years that the change of the flow from export from China to import into China. So the import into China has been increasing very rapid. Now I'm working in the food industry, so I can't say for the whole economy, but for food industry, we're seeing 13% growth rate, CAGR growth rate in the past 10 years. Say in 2010, 10 years ago, the total import of food into China was like $27 billion value. And in 2020, 10 years later, 2020, the import has increased to $107 billion. So it's huge increase, and it still keep on growing. And even last year, 2020, the growth rate, year-on-year growth rate, was 18%, more than 18%. So why is such a big increase of import, especially in food business, in food? So one thing is the overall income of the people in China has increased dramatically, and they have more purchasing power. And secondly, people they have been traveling all around the world. Chinese people like to travel, like to see the world outside China. And when they go outside of China, they discover the new products, especially they want to taste all the different foods around the world, and they get interested and they get hooked. So when they come back to China, they still want to buy it. And another thing is that we are seeing a lot of purchase of the consumers of imported food products, not only in the first-tier cities like big cities, metro cities like Beijing and Shanghai and Shenzhen. We're also seeing more and more consumers in the third and fourth tiers cities in China. So the trend is actually growing into all over China. So once the trend is formed, it's almost irreversible. So people start to buy, they want to buy the new things, they want to buy imported products. So the market is huge and it's keep on growing. Another thing we noticed is that the change in the level of consumption, the level of purchasing power. So say 10 years ago, the average transaction value for each consumer maybe like in the restaurant, for example, it's like 50 or 60 RMB for one order, but now it's almost 200 or 300. So they are actually buying more expensive products. They are not only buying the low-end products, they're buying high-end products. Like, for example, we used to import frozen seafood, and now we are seeing a lot of, for our company, we actually started this year importing chilled Norwegian salmon, which is a very good product, but quite expensive. But it's very welcomed by consumers in China. We're seeing a change not only in the volume, but also in the price level. Another thing that we noticed that is the consumers are getting more and more mature, or we call them here picky. So they don't simply, they actually transformed from the beginning when they started to buy imported products just because of novelty, just because they want to try something new. Now they are getting more and more difficult to be satisfied. They're actually trying to buy the products that are to their taste. They're not only trying to get the nutritional value, but they want to be satisfied all around, like the tastes and the packaging design. So it's more and more difficult to satisfy the consumers. I mean, they are more and more picky in giving. They don't simply take what is given. They're actually more demanding in selecting the products, which is making it more challenging, but which is making it more interesting for us. So that's why we started the concept of Made for China, instead of just moving the product simply from abroad to China market. We have to make it tailor-made to the different categories of consumers to make the products to their tastes, their like, their interests. So what we're trying to do actually is to present the products in the form, in the shape that the consumers in China like. So take, for example, cheese, for example. Chinese people are actually consuming a lot of cheese. It's hard to imagine. Chinese people, we are actually importing a lot of cheese, but the Chinese consumers are not consuming the cheese the way the Americans or the Europeans consume cheese. They're actually not mixing the cheese in a salad or served in a platter at dinner table. They're actually eating as lollipops. So it's hard to imagine, but they are actually eating it the way they like. Take another example, tea, for example. We know that tea is originally grown in China, but it's also consumed in the UK, in England. It's hard to imagine the English people drink tea in the forms of tea leaves, the way Chinese people drink. So what I'm trying to say is that we have to adapt the products the way the consumers like. The consumers consume the product. So that's what we're doing. So that's why we come up with the concept of Made for China. So we have to adapt ourselves to please the consumers. And so we need to. So what we are trying to do is to try to build a bridge in the production and the consumption. So we're trying to help the producers to present the products the way the consumers like. And on the other hand, we're trying to help the consumers in China to find the good products in our different origins. So, and that also makes me think why the organizations like CGCC is so important. And CGCC puts all the different parts of the value chain together. They put the consumer product companies and also the producers and the shipping companies all together into this organization so that we can meet each other and try to make the flow of the products more efficient. So that's my understanding of why we use the word "made for China." Thank you.
Thank you. Yeah, thank you, Mr. Liu. That's it's very exciting to see the the changing mechanism in cross-border trade, driven not only by consumer demand and preferences, which you highlighted, but also what you also alluded to, which is the structural transformation within the domestic economy itself as well. So now, Paul, similar to COFCO, your company, COSCO, is also a massive multinational corporation, very much entrenched in the U.S. China cross-border activities. How has your business progressed the last few years, and what are your strategies to cope with the complex business dynamics as the U.S. China trade relations evolve?
Thank you, Lu Chao. The primary driver for COSCO Shipping North America over the past several years has been to scale up in our diversification and our range and our resources. And this is to satisfy the growing logistics needs of our customers and to provide them with a comprehensive end-to-end solution. End-to-end solutions have been a much more popular approach to moving cargo through the supply chain, with one service provider who can meet all your needs straight to the final delivery mile. We've done this through fortification and an expansion of our container, our terminal, and our equipment leasing operations, as well as our integrated logistics services. Geographically, in the United States specifically, we have fortified our comprehensive service network to reach every and all locations in the United States effectively. And in all of North America, in fact, and in Central America and the Caribbean, over the past 4 years, we have expanded our network and our reach to include services to all major ports throughout the region. And all the while we're doing this, COSCO doesn't lose sight of the fact that we must remain a responsible corporate citizen. This is extremely important to us, and it's also important to our customers and our partners. We maintain a constant diligence over security. We do this in one way by being a certified member of the United States Customs and Border Protection Trade Partnership for the past 20 years, which helps to protect the borders of the United States. We're also aware of our environmental sustainability responsibilities, and COSCO participates in a variety of green initiative programs throughout North America to support our commitment to reducing our carbon footprint. For example, we are a member of we're a founding member of the Port of Long Beach's Green Flag Initiative program, which is a voluntary speed reduction program to reduce the effect of our vessels on the environment. And we're also a signatory to the Blue Whales and Blue Skies Initiative. Through many partnerships with our customers and our vendors, we provide financial assistance to various foundations and initiatives throughout the region as well. Most recently, in our hometown, in our headquarters in New Jersey, COSCO was recognized by the town mayor and the regional hospital system for our efforts to support their needs during the COVID-19 struggle last year. So we take a comprehensive approach to providing the most comprehensive and full suite of logistics services, while at the same time not allowing ourselves to step outside of our core principles.
Thank you, Paul. So to your point, I think being strategic and socially responsible while tactically enhancing local presence and capabilities is extremely important for multinational companies like yourself to stay ahead through the various challenges, especially outside of the home market. Now, Matt, what about you? What have you seen in terms of the opportunities and challenges in the U.S. China trade, and how have these impacted your business and your strategy?
Sure. Before I jump into that question, let me go back to Paul and say thank you, Paul, because one of the things that we you said two key things for me. One was using one dedicated carrier throughout transit, right, from A to B, to and from. And then the second is security. Both those items are items we talk about with all of our assureds, all of our partners, many of the Fortune 500, many of the 1,000 companies, trying to utilize one dedicated carrier and what security is in place, especially during this time. So that was great to hear, Paul. Thank you. Great. So to answer the question, April, the opportunities and challenges. I'll tackle the challenge first. Obviously, the China trade events. I'll associate that with COVID as well. It's impacted the industry. Obviously, we're all aware of the accumulation issues of cargo waiting out to be discharged, brought in to be discharged at the port. But it's not just the accumulation out on the water; it's the accumulation at the ports, waiting for transit, to get on the vessel. It's also at the truck yards. That's where I go to my point to Paul with security. That's a big concern. We're working closely with our assureds to ensure that accumulation, those risks that normally would have gotten on the vessel and gotten to their final destination much faster, that time that they're waiting, it creates a security issue. Not only a security issue, it also creates a CAT issue, a CAT peril issue for their goods. So we work closely with our assureds to ensure that their goods are being monitored, protected to avoid any possible CAT loss or theft or pilferage due to the delay in getting these goods out into the ports and then on the vessel and then offloading at the vessel. The opportunity it's created for us, specifically Starr Marine, is it's allowed us to emphasize our partnerships, our long-term partnerships with our assureds, our clients, and it's also emphasize our global network. So China companies looking to export their goods throughout the world have been able to utilize our global resources to provide the transit, ocean-going transit, the inland transit, and storage throughout the world without any concerns in terms of our gap in coverage. And on the reverse, for companies shipping into China, because of our local presence and our offices there, we're able to meet their insurance needs by getting them admitted policies in country, either for, again, inland transit and or storage.
Thank you, Matt. It's good to hear sort of, I think what Mr. Liu and Paul just shared with us with regards to, how your companies are adapting to the ever-changing trade environment is actually an excellent preface to my question next for David. David, so as you are covering a number of the key manufacturing and other industrial companies, how have these multinational corporates been dealing with the overall U.S. China trade dynamic, and what are they preparing for next?
Sure, and thank you. First, I want to thank the panel. Anchoring home one of these points here, and your comments up to this point have been very interesting to me. Now, I hope that I can be contribute as well as you've contributed also. But as a credit analyst, my point of view comes from the point of the observer of what's going on in our industries. So when you think of trade relations and trade with respect to the manufacturing sector in general, especially in North America, but globally, this sector has been reacting to changes in trade and the trade environment for many years now. Regardless of administration, regardless of policies on either side or in any jurisdictions. Most of the multinationals are very highly diversified companies, not only in terms of the end markets that they serve, but also in terms of their sourcing. And this has allowed them to be able to shift production, shift their sourcing, adjust their supply chains as necessary when there are disruptions to production, disruptions to a source of input, whether raw materials, partial input components, etc. And as a supporting factor to this, look at the around 2018 to 2017 and 2019. During the evolving trade situation involving a lot of the industrial sector, very few of the large companies have had material interruptions from have faced this due to trade disputes or any sort of anything that might have affected their supply chain as well. And this but they were certainly acutely aware of it. So this stresses the value of having nimble operations. I think that's sort of the catchword that we have heard, that allows them to change their sourcing and ultimately adjust their production. So in terms of multiple sources of input has been very important in many of these companies. Insourcing has been awfully important, not just to not be too reliant on one source, regardless of where it is in the world, not to be, or even within the United States, to be too reliant on that one source. Increased investment in technology. That's a long-term trend that's ongoing and will be ongoing. We recently did some research on this in the manufacturing sector about a number of companies that have invested in software. Big metal bending and manufacturing companies investing in software. Very expensive, but they feel it's very worthwhile to decrease the reliance on labor and possibly decrease the focus on where something's produced. And then finally, this has been an ongoing trend involving local production. This is really important, that a lot of companies have been spending a lot of money kind of quietly investing in the regions in which they sell, not only to be close to the market, not only to shorten their supply chains and reliance on long trade legs, but also because service and aftermarkets are becoming an increasingly important part of the manufacturer's operational footprint, meaning you have to be in the location. You can't just have a sales office there. You have to be producing. You have to be teaching people there to be authorized agents. You have to be with the customer at all times in those places. Of course, this hasn't, as we've seen, it hasn't gone terribly far as removing the reliance on international trade. As we see today, they are just as much exposed to, and they're not immune to the slowdowns we see from the current supply chain problems. But this playbook, this is one of nimbleness and local production, et cetera. It's worked well for short-term disruptions we've seen in the past, whether it be strikes, hurricanes, you name it. We think that this could become a bit of a problem if the supply chains persist. So as we go into next year, I think we're going to be hearing different things from the manufacturers. Going to be hearing different alarms of caution if they are not able to work out their shortages and get back to a more normal and fluid environment of sourcing that as they have in the past.
Great, thank you, David. So if it is to summarize sort of your observations, right, being nimble and flexible and localization seems to be very much key. And I think you also touched upon sort of, supply chain, sort of what's, in the future, which is a great segment actually, to our next topic, which is logistics and supply chain. So with this topic, let's go with COSCO first on this one. So Paul, how have supply chain constraints and, events in the past year affected the logistics industry that you guys are in, right? And what are leading players like COSCO doing to overcome these challenges?
Yeah, thank you. And thank you to all my fellow panelists for all your comments. Regrettably, the global COVID-19 effect on the supply chain from production straight through to the last mile has been detrimental. It's affected operational capacity and capability of every sector, ocean carriers, ocean terminals, and all origin and destination service providers. Where the market witnessed an abrupt 35% contraction in some regions in the second quarter of 2020, we're now seeing cargo moving through the network at volumes we've never experienced before. The network, from an infrastructure and a labor perspective, is not designed to cope with either end of this vast volatility and the unprecedented volume and instability that it has produced. So it's really a very unstable situation right now. Currently, demand outweighs supply and capability in all major shipping lanes, and particularly in the Trans-Pacific. The combined consequence of increased volume and reduced operational efficiencies at all points in the logistics network has resulted in delayed vessel transits, congested ocean and rail terminals, and a lack of vital domestic delivery resources, including distribution, warehousing, trucking, and other delivery essentials. And on top of that, there's also a lack of skilled labor. COSCO Shipping North America has been diligently working continuously to address these issues as practically as possible. Through our subsidiaries, including our ocean terminals and our equipment and logistics entities, we're fortifying our efforts to the best of our ability through fixing berthing for as many vessels as possible. We've added additional leasing assets, such as chassis and reefer containers that we are building and leasing out to the market at as fast a rate as possible. And we're also doing our best through our logistics company to provide our customers with trucking and warehousing solutions, while at the same time trying to be as flexible as possible. Some specific areas I can touch on. One is capacity. So as a result of global port congestion, COSCO Shipping Line's vessel utilization reduced approximately 20% in the first half of this year. To accommodate this in the Trans-Pacific trade, COSCO Shipping Lines positioned vessels from other trades into the market, and we increased our steaming time to make up for some of the delays that we were experiencing at the port. We also chartered additional vessels, as many as we could, but the market became scarce, as we know. These vessels that we were chartering in were at higher rates than we had ever seen before. Despite that fact, COSCO was still able to maintain competitive ocean freight rates for our customers, which average about 1/3 to 1/5 of the spot market rate today. So we're still remaining quite competitive and quite a reasonable option for our customers. From a service quality perspective, the pandemic is not going to be resolved in the short term, as we know, and nor will its effect on the global supply chain network. So this is making it very difficult for all logistics providers, including COSCO, to maintain that same level of service to our customers that they were accustomed to pre-pandemic. But nonetheless, we've adjusted our workforce in a safer virtual environment, and we continue to provide very good services to our customers, and we'll continue to do so throughout. Some of the infrastructure changes that we've made and additions is we've added some storage yards for our customers, particularly and most recently in Chicago and Seattle. Our customers are finding it difficult to both pull out their containers, their loaded containers from our terminals, and then once they do, they have no space in their warehouses to put the cargo. And then once they do find space, they have a difficult time returning the empties. So we've opened up storage yards for them to use nearby that they can easily drop off those containers, and we'll work with them at a later date to find ways for us to get those containers back. And then finally, we've done our best to support the inland transportation operations. Again, through our terminal and our logistics leasing companies, we've made substantial capital investments in infrastructure, and we've also procured additional assets that we have immediately turned around and leased out to service providers, not only of ours, but of the market in general. And we've been able to do so at reasonably low common lease rates, which has helped to bolster the availability of assets throughout the supply chain. Thank you.
Excellent. Well, I think you mentioned it again, sort of repeating, sort of flexibility, right? So I think it's important to be flexible and strategic to overcome the constant changes and the unpredictable, of course. And speaking of unpredictability and flexibility, Matt, while we have all felt the impact of the supply chain shortage, are some companies able to effectively make alternative arrangements and changes timely enough to meet the demand?
Yeah, yes, absolutely. Many of the larger U.S. large box companies and many of the larger companies outside of the U.S. are chartering their own vessels now to get the goods from A to B as fast as they can. Many of these vessels are smaller, so they can access smaller ports, if you will, so that it's easier to get in and out of those ports. But when you charter a vessel, it does present its own challenges as well. You want to make sure it's classed correctly. You want to know where it was before. You want to know what cargo was on it before, because if some cargo can't be mixed properly, mixed together without causing a problem for the cargo. So there's a lot of questions when they do charter themselves, but we are seeing the larger companies doing more of that now to avoid delays. The other alternatives are some are choosing air, which is obviously a safer risk, but it tends to be more expensive. But it does get your cargo from A to B a lot faster. And then others are where possible are going the inland route or via truck or rail. For truck, what we're advising our insureds on if they're going that route is obviously wherever in the world that the proper infrastructure is there to manage the truck drive from A to B without any harm, and as well as security again. Not only infrastructure, but security to ensure that their goods are protected. We want them to stop, obviously, in safe, protected areas, because once you leave the truck, once the driver leaves the truck, the goods become a major risk for theft. So, but there are alternatives. Air, again, chartering your own vessel, air, which can be more expensive, and truck, which we've seen a lot more of.
Great examples you share there, right? And again, I think you do need to be nimble, right, in sort of changing sort of your operations a little bit, or sort of your approach to actually cater to sort of demand and sort of managing the different elements of your business. So, Mr. Liu, going back to changing trends and situations, how has a world-leading food commodities company like COFCO been handling the resulting issues from these supply chain disruptions that we've been talking about, and be it impacting your end consumers or other sort of parts of your business? And are you seeing any differences in the U.S. market versus in China? Oh, you're on mute, I think, Liu. Great.
Okay. Sorry, I forgot I was on mute. Okay, yeah. Yeah, we definitely I've seen a lot of big challenges, and of course we have been trying very hard to meet the challenges. So actually, in the beginning of the COVID, we actually had a lot of disruptions, and we had suffered from some losses actually when the products arrived at China. And they were found COVID affected, so we have to get the product destroyed or returned, and we spent a lot of time to work with our suppliers and how to solve the issues. So luckily we had a very good working relationship with the insurance companies, so we started to negotiate and to find out different insurances on the products so that we can reduce the risk. Which is very important for this industry, especially for food. We have to make sure that the food is safe for our consumers, and at the same time, we have to try to reduce the risk for both ourselves and our suppliers. And also, we try to work with all the different with our suppliers and our customers to coordinate the time of the supply and arrival of the products to keep safe inventory, and at the same time try not to have too much redundancy, so to still keep ourselves competitive, which is very difficult when this logistics is in such difficult shape. So which is why I think the other panelists mentioned that it's very important to be flexible. So we try to diversify our sources of supply, and not to rely on one origin, one supplier, so that to spread out, so to reduce the risk. Again, to reduce the risk. So yeah, we we're trying very hard to balance the efficiency and safety of supply, make sure ourselves to be competitive in the market, but at the same time we have to make sure that we have enough supply to keep the cargo flowing to meet the needs of our consumers.
Impressive, and yeah, and I think it's interesting to see the different approaches and similarities amongst the large multinational companies in dealing with the current situation. So now let me turn to you, David. Obviously, we talked a lot about these semiconductor shortages, labor constraints, and other bottlenecks that have resulted in serious supply chain issues impacting industries across the board, as well as retail consumers, right? So is now the focus gradually shifting to the assessment of end demand, and what are you seeing from the sectors that you are covering?
I think that's really spot on where we have to shift our as an analyst, looking forward, and yeah, end demand, and when that demand curve shifts, the short-term demand curve shifts, is going to be very important for us to consider. And what we've seen so far, again, among the manufacturers who have to supply everything like aerospace, oil and gas, capital goods, all the way down to either directly or indirectly the consumer, and I'll speak of the U.S. consumer, what I'll focus on here. They're facing sort of a paradox that they're trying to plan around right now. So if you're listening to the recent earnings calls, for example, of really all global manufacturers, or if you've seen the recent, the J.P. Morgan market purchasing manager indices that just came out, it would look like everything is very rosy, very optimistic. The purchasing manager indices are still showing expansionary trends in all regions. The companies reporting have been talking about record levels of orders and backlog, and they've been able to deliver, in some cases giving nothing more than lip service to tightness from supply chain, which everybody here knows that there's a disconnect there, isn't there? That this can't go on forever. And I appreciate, especially Paul's comments on the food sector, that this very, very adept management inventory is a tremendous challenge vis-a-vis remaining competitive. I'm hearing that from manufacturers everywhere. To be competitive, I need the inventories, but that's completely anathema to what we've been doing for decades now on inventory management. The playbooks have sort of shifted. So what does happen going forward is the price pass-throughs have worked fairly well. The manufacturers, especially, again, I talk about the big ones, have good pricing relationship or good cost relationships with their existing contracts with suppliers, with the transportation firms, with their labor, for example. That's all relatively near-term in nature. At what point, on the other side of the equation, the ability to pass through to customers has been very efficient, and a lot of that goes to the stickiness of their particular product. Maybe it's because of the services they provide along with it. Think of a company that makes elevators. You make an elevator, and you also have 20 years worth of service that goes into it. So they're able to pass through. I'm not picking on the elevator industry. They're able to pass through these costs fairly effectively. What happens when the demand pushes back? On the consumer side, inflation is still hard. The classic inflation model says the consumer will spend less. They'll stop buying at a certain high price. On the capital goods side of things, the demand will still be there ultimately for that part, but maybe we won't do it this year, which is something we've seen in other recessions in the past. We'll push off that spending on the big component. And you mentioned semiconductors. That's a great big one, because these diversified manufacturers, just about all of them have an automotive component to it. Brakes, valves, wiring harnesses, whatever it might be. And they might not make semiconductors, or they themselves are reliant on semiconductors, but their clients, the original equipment manufacturers, OEMs, are heavily reliant on that, and they'll stop ordering too. So that short-term supply curve, which is really now showing a lot of inelasticity of demand. As the price goes up, we'll simply pay it. we need to get your items on the shelves. If that shifts, that could, we think, fairly quickly slow down demand, slow down orders, and slow down production, because companies in that manufacturing sector are now going to start finishing and selling out their inventory, much like they had early in COVID, which is going to put means that this very rosy picture of production that we're seeing in the industry could go negative relatively quickly.
And that will have a trickling effect too, right? So because when, the demand sort of is a little bit more subdued, and then that's going to trickle into other areas, and that could impact the overall economy. So that's a little concerning, isn't it? I mean, it could sort of, I guess the companies need to sort of think about what they need to do to ensure that, there's sustainable demand, and then ensure that, the demand and preferences will have some kind of stability. Or is that sort of a bit of out of their control, you think, from that perspective?
I think that it like with any recession, slowdown, inflection in the manufacturing or the industrial cycle, they tend to correct rather quickly once you can, work through the inventory issues and, and get the consumer back to buying. Because let's face it, the F-150s will fly off the lot again. That's once they're back on the lot, and that's going to be, there could be an interruption to the labor market, but the labor market is also flexing their muscles. We're seeing right now, witness the deer strike. They will be able to adapt. It's kind of the point there. And I don't mean to sound too alarmist in that there's a great deep recession that will come from this. I'll leave it to the macroeconomic minds on that one. But I think that we have to be aware that production can slow rather quickly. There could be a rather quick change in production trend and sentiment rather quickly because of end market demand.
Yeah, and these, I think that these manufacturers, these companies, that again, flexibility, nimbleness, right? Just sort of how you then adapt to that situation is going to be important. And then you wanted to have that sort of institutionalized mindset and system to flex your muscles when it's needed.
Right.
Great. Yeah. So it's wonderful to hear the different perspectives, the observations and experiences as we weather through these ongoing challenges that impact geopolitics, our businesses, and everyday life. We're now at the end of our main discussion section, and I think there are a lot of questions coming in, so we'll open up for Q&A. Let me pick one to start, and please keep your questions coming. The first one is for actually both Paul and Mr. Liu. What are the biggest challenges facing shipping companies and food companies in 2022, and how should the industry deal with it? Paul from COSCO, would you like to go first?
Sure, thank you. Recent discussions that we've been having, particularly about the Southern California operating hours and how to improve gate transaction velocity at the ports. This is very meaningful and very constructive, and we are participating actively in these conversations. However, advances in this one segment is not going to really be a fundamental change if we're not seeing equal improvements in other areas of the system, which is distressed overall as a result of the volume. So, short of taking a similar approach that bolsters all infrastructure deficiencies based on current volume, congestion will continue to persist at random choke points. But at the same time, we really can't let a pandemic be the foundation upon which we consider capacity planning, right? It's just an extraordinary circumstance. So it's a very it's a tight balance that we're walking right now. And an effective logistics network that is capable of meeting the demands of predictable ebb and flow is really what we need to have at all times in order to do the best we can to meet the demands from ship to shelf. And so that's really, I think, what we need to find out is what is our baseline, And our baseline is unfortunately not going to be pandemic related volume that's unpredictable and unprecedented. At the same time, we're facing a significant problem with a lack of workforce in all the distribution network areas. And this has been a growing problem for some time. It's just being brought to the forefront with COVID. So I would say that next year, more time and consideration really needs to be given to developing comprehensive incentives that will entice qualified individuals to consider these essential occupations in the future. But again, the key question remains making predictions on how long this surge will last. And that is if consumer spending and lifestyle changes will continue elevated, and for how long, right? When as David mentioned earlier, when are we going to see that shift back, and what exactly is that shift going to be? So the expansions at this point are not easily projected or accomplished, and considerable investment and retooling proposals will take some time. And at the same time, they must be proven long-term sustainable. And going back to my original comment, using a pandemic as the baseline of what is long-term sustainable is not an effective model.
And that sort of long-term sustainable kind of theme is ever changing as well, as we can see from the last couple of years. Great. Mr. Liu, what's your view?
Okay. Well, thanks for well, actually, for us, we see that the continuing challenge will still be the logistics coming from the logistics. It's very challenging to make, like I said, to make our products still competitive and cost efficient, and to make sure that our customers will have enough supply. So which is still a big challenge for us, probably for the coming years, and we don't know for how long. Another thing is that we're trying to see how the cost can be effectively passed on to the end consumers, so that the whole value chain actually are sharing the cost, not only by one part of the value chain. So we still don't, we still haven't figured out yet exactly which products are being rationed by the high prices, high costs, and which products will eventually be more welcomed by consumers. And the challenge is that it's constantly changing. Like in the beginning of the COVID, we find that the consumption in the restaurants dropped dramatically, and nobody is going to the restaurant. So so the consumption of long life products like canned food, for example, very welcomed by the consumers. They buy a lot of products and bring them back home and store up for a month, and so to make sure that they have enough food. But then very quickly, because the situation in China changed very quickly, and then people started to going back to the restaurants. So people start to consume a lot more fresh produce, and so we have to adapt very quickly, try to find enough supply of fresh meat, fresh fruits, and everything to supply the restaurants. Interestingly, the last few days we see that there's a little comeback of COVID in China, and people are starting to store up all the long shelf life products again. So it's very hard to predict the unpredictables. So that's a big challenge for us. So like it was said just now, that it's very hard to find the baseline. So to plan for the near future. So what we're trying to do is trying to keep ourselves nimble and flexible, and to try to adapt as quickly as possible to the changes in the market.
again, talking about flexibility and being nimble, based on what sort of Paul and Mr. Liu you're talking about, we do see, large companies like yourselves, you have a whole system, right, of preparing for various potential issues and impediments sort of down the road. And then you talked about the elasticity of demand, and that's something that's very hard to predict. But still, you are trying to stay afloat and sort of trying to overcome these challenges on a timely basis. So we talked a lot about sort of large companies. Why don't we switch gears a little bit, as I see a question coming in concerning, corporations of smaller scale. So to all of our panelists, what advice do you have for small to medium-sized companies whose primary services and products rely heavily on the smooth operation of supply chain network and logistics? And these companies might not have all the resources and the flexibilities that the large multinational companies have. Any comments on this question from the panel?
I can jump in on that to start the conversation. We've advised our smaller or mid-level clients to first make certain that their contracts are in good order, they're up to date with their carrier, and second, really focus on the second and third tier supply chain. And I go back to security, right? That's critical. So they should really focus and make certain that there's visibility on their product at all times to ensure that it is protected and that it is being handled properly, so it gets from A to B without event.
Thank you, Matt. Any other comments?
Just adding on Matt's comments, on the front end, we find planning ahead, communications, and flexibility to be extremely important. That helps us to provide more potential solutions for our customers. And on the destination end, being prepared to expedite the retrieval of the cargo and then get us our equipment back so we can put it back into service and have it back in Asia to meet their next shipment. That's also very, very helpful and quite essential. So communications with our customers, no matter what size, but especially the small and mid-size, and understanding what their needs are, that helps us to be prepared to meet them.
Yeah, transparency and communication, very important as well. I think there was a question coming in. I think perhaps David, you can kick off first. It's really regarding, when you look at the companies that you're covering, right? And looking forward, they're preparing for different scenarios. And one of them is sort of what sort of government policies or actions will then, have a resulting impact and implication. So any thoughts on that? Sort of what do you think governments or sort of the international community could potentially do, or what they might do could impact this sector?
Well, I think perspective I come from will be from the corporate finance side of things, where the individual company, there's the strength of their balance sheet and their liquidity are paramount here. And we only have to look 1 year ago, year and a half ago, when there was just this much uncertainty when COVID set in, and there was really no transparency on planning whatsoever. Everybody just stopped giving guidance. Hands were thrown up. What are we going to do next? We got very concerned about the smaller companies, sort of go back to the last theme, whereas the larger companies were able to handle this with aplomb, largely because they had liquidity. They were already generating a good amount of cash flow. Their margins had a lot of cushion to them. They could take a lot of bend as far as top line changes are concerned. It's the smaller companies that might have, don't have the pricing power, both upstream and downstream in their supply chain, customers and suppliers. They might not have the margins or large enough margins to absorb that cushion either. So in some cases, yeah, it's you can't fix the roof on a rainy day. If their balance sheets are not in order, they're going to be suffering. And a number of sort of low-rated, highly levered companies were facing difficulty, but ended up being for a relatively short period of time last year. Eventually, orders did come back from many of them, and many of them are reliant upon bigger companies in their supply chain. If this is something that persists, they might not have that luxury this time around. So companies that have not only have a lot of debt, but have to refinance a lot of debt might find that difficult if the environment persists. So there's, at this point, what's in their hands is to, financial policy to make sure that they're not too shareholder friendly, too aggressive with, for example, share buybacks that might stress their credit risk. Now, you're hearing this strictly from someone who's writing and doing analyses for the credit investor community. But nonetheless, we see this as the balance sheet and financial policy as a major form of risk that is well within the control of manufacturing firms.
So need to continue to be very prudent, right? And especially in situations like this. Any other panelists that, in terms of sort of what you, either sort of your clients or your company or your sector, looking at potential government policies or what you hope or wish the government would do that could be helpful in sort of, alleviating some of the situations that we're facing right now. Any thoughts on that? I think, there's a lot of unpredictability in the government policies as well. And I think, again, going back to our common theme, which is the flexibility and nimbleness. And when things do come down, you do need to have a strategy as to how you are going to overcome those challenges. All right, let me go to something a little bit more specific, and feel free to jump in, but I think perhaps Paul, you want to take the lead on this one. There are quite a few questions about the port situation, in LA and Long Beach, and sort of, what the Biden administration has done. And I think they start to, impose fines, and how is that impacting things, and, COSCO, or what you're seeing others are doing. Any thoughts on that?
Thank you. President Biden's supply chain disruption task force has been working very closely with all industry stakeholders. And I think one key point here is to just sort of outline that there are so many industry stakeholders in the supply chain. It starts with the port authorities, terminal operators.
Yeah, I think, Paul, you're breaking up a little bit. Maybe if you want to turn your video off temporarily so we can maybe hear your voice better.
How is that? Is that better?
Yeah, much better. If you can start over, that's okay.
Sure,
Thank you.
sure. Sorry about that. So, yeah, President Biden's supply chain disruption task force, they've been working very closely with all industry stakeholders. And as I said, I think it's important that we recognize that there are just so many participants in the supply chain. We have port authorities, terminal operators, ocean carriers, railroads, trucking companies, intermodal equipment providers, warehousing, distribution centers, deconsolidation centers, cargo owners, and so on. And all of us are working collectively with the supply chain task force to seek productive ideas on how to ease the ill effects that this unprecedented volume has caused. Not only in LA Long Beach, but all throughout all the U.S. seaports. Most notable in LA Long Beach just because of the volume. COSCO Shipping supports all the initiatives of the task force, and we're working diligently with them to try to find solutions. Recently, just as an example, COSCO Shipping Lines brought a vessel to the Port of Los Angeles. This vessel did not discharge any cargo. This vessel came with the sole purpose of loading out empty containers to take some of the stress off of the terminals, to allow them to have more space to spot loaded cargo, and to allow them more flexibility to get that cargo out of the gate. We plan to do this again, maybe in another 2 weeks. And as we see, a lot of our competitors are starting to do the same. This is just one area where we're taking initiative to find unconventional solutions to solve the problem. Thank you.
Great. Any other comments before we move to the next question? Good. So keep those questions coming to the audience. So I guess we talked a lot about the challenges, what we're facing, how things could be, alleviated or some risk could be managed. Are there any sort of clear winners or losers? Or I guess the other way to look at the question is, through the sort of the U.S. China trade and also some of the supply chain issues that we're facing, any sort of positives that are standing out that you see, or perhaps through this experience, what are lessons or sort of, things that the companies that have accumulated that will actually have a positive impact in the long run? Any thoughts on that? I don't know, David, in your industry, do you see any sort of positives that's coming along with some of the issues that these companies need to deal with?
I think that unfortunately, once you get to the manufacturer's level, or really the general industrial level, the lessons learned will become new innovations kind of after the fact. It's hard to see where these things happen yet. Now, I'll use an analogy that we've seen before, which was when U.S. oil production several years ago just exploded with fracking, if you will, and the pipeline capacity wasn't there. So all of a sudden we discovered that the U.S. railroads became excellent, at least for a short period of time, probably still are, at carrying crude oil by rail to the point where it became a viable alternative to making putting pipelines in. And I think that's kind of the way we'll see the improvements down the road. The companies are making the investments right now. They'll keep on making the investments. And I think as time goes by, we'll see the benefits of these technology investments, for example, from many of these large industrials, Emerson, Honeywell, Rockwell Automation, et cetera. I've done a number of these investments, even though they're very expensive, and it's very hard to see what they're contributing, at this time. And another thing that I think will drive a lot of this is I always like to point this out is the manufacturing sector in the United States is maybe 12% of the economy, but 8% of the workforce. So it's already a very efficient generator of generator of wealth in the U.S. economy. And so long as I think that the manufacturing firms would really like to get that the number of touches of a product down, the head count, less reliance on head count down, that is going to be able to drive a lot of what you'll see as far as the lessons learned, if you will, and those lessons will be technology.
The technology is key. I think Debbie, you've mentioned it a number of times, and I know our panelists are from different industries. Any thoughts on sort of where you see technology playing an increasing? I mean, we know technology is going to play an increasing role in our operations. What else are you seeing that technology has made a difference, or any sectors that that's kind of stood out?
A lot of companies have become more competitive in the industrial automation space recently, and we think of that space as the robotics companies making the great big machines that go onto the assembly line and replaces a human being with a robotic arm. It's more about data collection and data usage, which is really the next phase of industrial automation. And I'd be curious, myself, what's going on with ports, for example, and how this allows you to interact with other modes, because the manufacturing space is not just a matter of, the auto manufacturer being able to automatically put a part on and moving it into the finished goods line. It's a matter of being able to put something on that communicates everything from the manufacturing all the way to the end user, all the way to the complete life of that product. And I'd be kind of curious if there's something at least on the North American intermodal space that is also sort of addressing that kind of initiative, if you will.
Great. I think that's it sort of from, I've summarized all of the sort of the Q&As coming in, and I think our panel discussion today is coming to the end. I want to thank, to all the panelists for the candid conversation and sharing and of your sort of insights and experiences. And thank you to all of you in the audience for participating and asking great questions. We look forward to our continued discourse on various important topics on this great platform CGCC has provided for us.